Yo, 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 what's happening, people? All right, then. So the topic for today is understanding buying the dip. What is buying the dip? Quite frankly, there is a misconception about buying the dip. When you buy the dip, you seem to think that the moment you decide to buy the dip, that's when the dip finishes and price is going to continue back up. This is where a lot of people can get burnt out, man. You see, the dip may continue for quite some time. All right? And it can keep on going down and down until the point where traders are so exhausted from actually waiting for the point where price is going to turn back up, their positions have ended up being liquidated, or they just can't tolerate it anymore and they literally close all their positions. And then before you know it, that is when price decides to make that move to the upside. So what is it that we need to be aware of when we take into consideration of buying the dip? Yeah? Well, first things first. What is the dip? Like, what are you basing the dip on? Are you basing it on the daily chart? Because we have been in a pretty long dip. Okay? It has just been pulling back non-stop. But this is what we have been expecting, ladies and gentlemen. Why? Because if we look at the cyclical pattern of Bitcoin, you can see that we've come away from this W formation right here. We've got a rise up level 1, retrace, rise up level 2. Now we've got this big retrace right here. However, it stayed within the previous peak right here. Now, when you are considering levels and cycles, this is how it can assist you in understanding where you are when it comes to buying the dip. So we understand that this is the cyclical pattern that we wait for throughout the whole stream in the Traders Reality channel. This is what we wait for. We make the assumption that this is the start of the week, and by the end of the week, we would have experienced a big move to the upside and then to the downside, and then we finalize again back at the peak formation. Now, it doesn't always go so smoothly. Sometimes we start the week on an M formation, all right? And then price drops, and then we go into the next week, and then price rises. All right? The idea is to try and establish where you are in terms of the cycles and the time frame that you are basing the cycles on. So on the bigger time frame, you can see from this W formation right here, we have got ourselves a rise level 1, retrace, rise level 2, retrace. Now, when you actually look at all of this here, you can make the assumption, or should I say, you can clearly see that we have been in a position to be buying Bitcoin at a lower price since the 10th of November. Now, the problem is people see buying the dip as when price pulls back, it's going to come down to a moving average and it's going to bounce from that zone. Okay? Look at this. Traders who saw this pulling back, they would have said, okay, we're buying the dip. It's going to come down to the 50 EMA. And if it goes beyond the 50 EMA, we'll have the 200 EMA as support. Self-fulfilling prophecy right there. It bounces and then it continues higher. The retail trader has now programmed himself to believe that all it needs to do in terms of buying the dip is we're waiting for it to pull back to a moving average, and then we're able to stack up in this area and move away from the zone. Well, what you need to understand is you have to think of cycles, all right? If we've just come from a peak formation, we see a nice move to the upside, we're expecting a pullback to form level 1. So price does that. Now, because price has come all the way down and tested at the 50 EMA, sorry, at the 200 EMA, we would expect this point in the chart to move price away to make a rise level 2. Now, if you actually match up all the liquidity candles right here, you can see that there was a red vector here and a red vector here, and they needed to come back up to recover those imbalances in the chart. Now, when I say imbalance, an imbalance is when a massive amount of volume or an exchange of contracts happens in a particular point, which throws off the order book, and then they have to bring the order book back into order so that they can start the whole process over and over again. Okay? Now, what we have to also take into consideration is the fact that what's the guarantee that the actual dip that we are seeing is going to stop and start to move back up? All right? Well, ladies and gentlemen, there is no guarantee on how deep a dip is going to be. What we wait for in terms of the actual cyclical pattern, so when we see a W formation like so and price retraces back, we anticipate that the moment it stalls in this area, a key moving average will be present, notable candlesticks will be present, and price will start to make a move higher. And if you actually notice what this W play is right here, it's actually the pattern that this channel is basing all its decisions on, which is the tattoo. We call it the tattoo because I agreed that if the Discord earns over collectively $500,000 using this pattern, I will get this tattoo, and we actually earned more than that. Yeah, I think it's like 4 or 5 million, something crazy like that. And that was based on the profits that have been posted in the Discord, okay? From the community, the Pattern Watchers community, all right? And that is what we are looking for when it comes to buying the dip, all right? Now, if we take into consideration Bitcoin on the daily time frame, it could be valid to assume that this pattern that you see right here, W rise up, retrace, rise up, retrace, which is a little bit deeper, and then we expect a continuation from this point on the principle that it's going to hold this range. Now, how long is it going to be before it starts to take the direction to the upside? What do we need to see? Well, firstly, we need to wait for price to close above the 200 EMA. And it's done exactly the same thing over here. It came below the 200 EMA and it trailed to the side, and then it found its direction. The problem with buying the dip is you'll never know how low this dip is going to be. But if you understand where you are in the cycle, you're going to have a good idea of when to get in on the dip. So for example, traders that see price pulling back to the downside, all right, they see it as buying the dip. They will start buying as price is dropping towards the next key zone. Now, if you were understanding the cycles, you'll be watching Bitcoin and saying, okay, I have a certain amount of money that I'm going to commit to buying Bitcoin at a lower price. Okay, so let's make the assumption that you have yourself $20,000, for example. All right. And say you say, I'm going to go long when it hits the 50 EMA right here on the daily time frame because I expect it to bounce away from that point. But what if it doesn't bounce away from that point? Well, then I'm going to commit another $10,000 at the 200 EMA. But what if it doesn't bounce from the 200 EMA? What do we do then? So then you would say to yourself, well, okay, let's see what it does at the support zones of the 50 EMA, because I will have enough time on the daily time frame to understand if it's going to actually pull away from this point. So you would have saved yourself a lot of money, okay, by waiting to see what it does at key moving averages. You see, when you look at Bitcoin pulling back to the 50 right here, some traders got caught out in the dip because it stalled. And then for what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days, okay, it stayed around the 50 EMA. And the idea of buying the dip itself, okay, was heavily installed in traders, and they thought that they were onto something and that Bitcoin was going to continue higher. However, the next day after this candle here, they dropped price and they attacked all of the liquidity of the traders who went long in this area here. Okay? But they started again to consolidate. Now we expect a W formation, rise up, retrace, to pull back to form a level 2 rise. And we saw that consolidation happen at the 200 EMA. We saw that they came back down towards this previous green vector candle. You see right there? Look at what they recovered. Just the lip of that vector candle right here. And then you've got the wick of this red vector sits right on that line right there. Now, the close of this candlestick right here would have told me that if they were going to go lower, they would have broken down. However, they had gone long themselves, as in the market maker. He's gone long in this zone, and he's consolidated price and held the range. Stopping volume candle right here confirms that. So as a trader who's buying the dip, it doesn't mean that you buy it when it's dropping. You buy it as it's coming away from the dip. So an entry point would have been valid as price would have crossed over all three of the moving averages that we use, 4 even. The 200, the 50, the 5 and the 13 EMA. That is where by principle your entry would or should have been at that point. Don't get caught out in buying the dip the moment it comes down towards the 50 EMA. Wait for confirmation. Don't be the trader that gets in at this point, because you're going to be the trader that gets stopped out at this point, and the other trader that was waiting for his confirmation is going to be using the liquidity that you put forward so that he can open up his trades in this area right here. Now we go over to the side where we can see price at right now. We are sort of in exactly the same situation right here. Now, how long is it going to be before they actually come back up to the 200 and start to hold out? Because you can see on the daily itself, we've got the 5 and the 13 EMA that have crossed below the 50 EMA, and they didn't cross below the 200. If you look ever so closely, you can see that the actual 5 EMA right here didn't cross the 200. So that was a good sign right there. And there's like a V-shaped pattern right here. And you look at the RSI itself, you've got divergence as well. So you've got RSI coming outside the volatility band, and then it's going back inside the volatility band. Happy days. All right. Now, in relation to what we see right here, what's going on? Well, you can see price has come outside the volatility band and it's now pulling downwards, and so is the RSI. So we need to wait. Okay? You buy the dip as the dip is coming away from the moment it's been dipping. This is the entry area that you want. You want it to be here, because at this point right here, ladies and gentlemen, you're going to see the 200 EMA is going to start turning like so. The 50 EMA is going to be behaving like this. And then you're going to start seeing a cross between the 5 and the 13 EMA. So the 13 EMA will start to cross over the 50 like so, and the 5 EMA will cross over like this, and then everything will start to look stacked to the upside. All right? The fact that the 50 EMA itself hasn't sharply crossed down below the 200 EMA is a good sign. You are looking for this behavior like this. Okay? You're just looking for a retrace bounce up. Right now, buying the dip can be a little bit of a treacherous situation. You're going to get caught out, because that's what buying the dip is. Buying the dip, in my opinion, is the best trap for the market maker to induce traders to believe that every time it's dipping and moving lower, every time any group of traders is going to buy, they believe that it's going to bounce from that zone. What happened to the traders that brought the dip at the 50 EMA? You think their liquidation points got hit? Look at the price action. Their liquidations were present, so the market maker attacks them. Look left, recovery of the green vector. Yeah? I hope that puts things into perspective. Now, this is on the daily time frame. When you apply buying the dip on the lower time frames, it's a little bit of a different situation. Why? Because buying the dip, all right, on smaller time frames, is all about understanding the reversion back to the mean. Look at this. Price deviates away from the volatility band, from the moving average. There's volatility, there's momentum, there is a flow of money coming into the market for price to go short, market makers going long. It reverses back to the 50 EMA. So if you were considering going long in this area, you would have known with the hybrid system itself that these red vector candles would have been confirmed and price would have come back to those points at some point in the future. So where would you have been able to enter long on that basis? Well, you would have understood that you were experiencing the first leg of a W formation. You're expecting price to pull back to the 50 EMA, and it does just that. Now, this is the point in the chart where you have to make a decision. It's the second leg of the W formation that is going to establish whether or not you go long from this point. So what do you need to see? Price needs to go above the 5 EMA and the 13 EMA, and it needs to close above the 50 EMA with conviction candles. When we say conviction candles, we're talking about vector candles, and they need to be coming away from the zone so that the chances of them coming back towards these vector candles is being supported with the intention of the market maker pushing price out. Looking at the RSI, you can see on this move to the downside, you've got volatility outside that band right there, and it's made a lower low right here. It's gone beyond the previous low, but it's higher in this volatility band area right here, and it hasn't broken the volatility band. So we've got divergence right there. You've got a stopping volume candle, the blue vector candle that shows itself right here. That is where you would admit your entry, or you start adding to your position, and then your full commitment of your position should be done the moment price breaks above the 50, the 5 and the 13 EMA on the 1 hour time frame. And for a short-term trade, you trade towards the next moving average, which in this instance would have been the 200 EMA. Granted, price went up a bit more, and you could have said to yourself, okay, I could hold this trade until they recover these previous wicks right here, but there's no guarantee that they're going to recover those wicks. But if you're paying attention to the way price is moving, you're going to understand if there is momentum in the chart to move price higher. Okay? So I hope that puts things into perspective for you when you are considering buying the dip, ladies and gentlemen. All right? be very cautious with buying the dip. Because these whales, market makers, the way they buy the dip is because they're in a position to be buying the dip at a lower price. It pays them to buy lower. They don't want to be paying high. All right? So if a market maker, or should we say, let's say a whale, okay? And I hate saying whales. It's just guys with big pockets. All right? If they're buying 300-400 Bitcoin or 1,000 Bitcoin on what we call the dip, it's very unlikely they're going to be worried about liquidation points. If you're in a position to buy 300-400 Bitcoin or 1,000 Bitcoin, liquidity is not a problem for you. In other words, you can be as irrational as you want, but there can be instances in the market where even whales can get burnt because they're not liquidity providers. They are not the guys that provide the liquidity for the exchanges to allow the retail trader to trade. They just come with big pockets. And when they come to the market, they don't just buy off the whim. They buy in increments. It's blocks. They buy in blocks. There's a block. There's a block. There's a block right here. If they've got 1,000 Bitcoin that they want to accumulate, all right, you think they do it in one transaction? No, it's done in increments. They average it in. So that when price does decide to make its return back to the upside, okay, they can take profits in this block right here. And then they can take some profits right here. They can leave their profits up here. Because if they just do it in one instance, their entry would be there. Price would probably drop. And then they would have to wait for price to come all the way back up. This is the market maker method. This is what they do. They buy when price is dropping. And then they get rid of the position as it starts to rise back up. Why? Because the liquidity to the opposite side of these orders is being taken. They will be selling, people will be buying. Yeah? I hope that puts things into perspective for you, ladies and gentlemen. All right? Looking at where Bitcoin is at right now, until Bitcoin comes away from this zone, we are pretty much stuck in this boring range. The US does have some news announcements later on today. Okay? So go check out dollar yen and Bitcoin and tell me what you see. There's a news play coming out today, guys, which could be the reason why Bitcoin is holding tight and not moving until that news comes out about the US. Go check it out. Mad love and respect to all of you people. If you are new to the channel, be sure to subscribe so you can get alerted for the live streams that happen on Tuesday, Wednesday, and Thursday. All right? Take care of yourselves, gang. Have a lovely weekend. Peace.